Hello friends, a very warm welcome to my channel. Due to the Russian and Ukraine tension, there's a global sell-off and there's a lot of panic in the stock markets across the globe. There are several doubts in the minds of investors whether they should buy or they shouldn't buy now, and if they want to buy, how much they should buy or what should be their buying strategy, investing strategy. So I thought I should talk about a few strategies in this video which you can use to systematically invest during a stock market fall or a stock market crash. So this is not just applicable to this particular crash. In any kind of a bear market, you can apply these strategies to systematically invest your money and optimize your portfolio for good gains in the future. So if you're new to the channel, please do subscribe and hit the bell icon, and you can join our Telegram channel where daily we discuss the market views and other stock specific news and analysis as well. Let's get started. So we'll start with a quote which says, "Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria." So this quote is by John Templeton, which is quite relevant in today's market, where we are in a kind of a pessimistic situation where there is a lot of news around the market that we should stay away from the markets and we should not invest, as people are giving very low targets on the Nifty and the other indices, and investors should stay away. So what should investors do in such a situation? We'll try to understand through this quote. I've tried to put this quote in the form of a picture so that we can easily understand, considering the recent COVID crash. So in the recent COVID crash, when the Nifty went to somewhere around 7,500 levels, so as you can see on the screen, that time was the pessimistic time where everybody lost confidence in the market and people were selling stocks at whatever rate which was available in the market. It was like a sell and run away kind of a situation, and it was the most pessimist atmosphere in the stock market. At that time, the market made its bottom. And when the market made its bottom, immediately a bull market was born. So the bull market was born when there was the most pessimistic situation in the market. And then when the market started to go up and made a small turn, it was kind of a skeptical situation where the market would tend to go up or it may again turn around and go down. So in such kind of a skeptical situation, the bull market started to grow even more. Once it went up and it became, people became optimistic that we have got a complete U-turn now and the markets are set to go up by much higher levels. Most of the people were optimistic about the markets, and those people who were short on the market also covered their positions as they saw the markets going up. So when everybody became optimistic, the markets tend to mature. And when did the market make its peak? When there was a situation of a euphoria where those who could not buy at the lower levels because of fear, they had a feeling of FOMO that they were left out, and everybody, including the existing investors and those who were left out, everybody was buying in the market, and there was an euphoria where all kinds of stocks, whether they are penny stocks, the fundamentally weak companies, and everything in the market was going up. So when that kind of a situation of euphoria was created somewhere around 17,000-18,000 levels in Nifty, that kind of a situation was where the market made its stop and the bull market was dead. So we are not talking about the permanent end of the bull market, but we are talking about this particular rally as an example of the last couple of years to understand this quote. So what we understand from this quote is, in the present situation where people are getting skeptical or people are very pessimistic, there is again a birth of another bull market, and you shouldn't be totally afraid and you should not sit on the sidelines as an investor. You should participate in the market, whether you participate aggressively or a little conservatively, that is up to you, but there should be some participation in the existing pessimistic atmosphere because of the Ukraine and Russian tensions. And to participate, you can follow one of these strategies which we are going to discuss in the coming slides. So the first strategy we will talk about is a simple time-wise SIP, which everybody knows. This is easily followed by most of the people who are investing in the market, mostly the newcomers who generally invest in mutual funds. So in a time-wise SIP, you invest a fixed amount of money at a fixed time, whether it's every month or every week or every 3 months or every year. So you do a time-wise SIP. So when the market is falling, you don't know till when the market would fall. So in the present scenario, either every day a small amount or every week a small amount or every month a small amount, you will continue to invest till the market fall continues or the bear market continues. So what happens as a result of this, when the market goes down and eventually when it comes up, your cost will get averaged and you will have a decent average cost for the investments which you have made. So this is a simple time-wise SIP which it is easy for anybody to follow. The next strategy which you can adopt is a price-wise SIP. So when I say price-wise SIP, these are just general names which I have given for the purpose of understanding. These are not specific fundamental concepts in any book. You can call it by any name convenient to you. So in a price-wise SIP, what you can do, suppose you buy a stock at rupees 100, you can decide that every 5% fall, I'll invest another small amount. So when you buy something at 100 rupees, you can invest the next installment at 95, then the next one at 90. So like that, you can keep a gap of just 5 rupees, which is 5% of your original cost price, and you can divide your investment into 5 or 10 or 15 installments, depending on how skeptical or how pessimistic you are about the present market crash reason. So based on that equal difference, you can keep investing the money, which is at a difference of whatever 5% or 10% you decide on your own. So this could be a price-wise SIP which you can do during any stock market crash. In this also, what happens is, when the market makes a bottom, your price gets averaged. So when you see that the market has made a bottom and it has started going up, you may choose to discontinue the SIP if you have sufficient position size as per your portfolio, or if you feel you want to further invest when you see the market has bottomed out and it has started moving up and it has broken the major moving averages on the upside, you can invest the remaining amount of whatever position you wanted in your portfolio, and you can fulfill your allocation to that particular stock. So this could be the next second strategy, which could be at the difference of a particular percentage of price. The next strategy, which is again easy to follow, could be an index level strategy. What you can do in this is, suppose the market presently is at, let's say, 17,500. The market has started falling from 17,500. So at a difference of every 500 points or at a difference of every 250 points, depending upon how pessimistic you are about the market, or when I say how pessimistic, I mean how much do you expect the market to fall. Suppose you expect the market to fall because of these reasons by, let's say, 2,000 points. So you can divide your allocation of that particular stock into 4 installments and invest in a difference of every 500 points. Or you can divide it into 10 installments and invest at a difference of every 200 to 250 points. So like that, you can start allocating your capital and invest in that particular stock depending on how much the market is falling. So when the market falls, if the stock is holding good, that also shows the strength of the stock and your allocation increases in this particular strategy. So even if the stock is not falling and the index is falling, that means the stock is holding strong. People are bullish about that stock in the market. It could be a fundamentally good company having good growth triggers in the near future, and your allocation automatically increases. Unlike the earlier price-wise strategy, in this your allocation automatically increases if you go on the basis of the index. A negative point in this strategy could be, as the index falls, the stock may not fall, but future developments, if they are not good about the stock, at that time the stock may fall. But that can be easily monitored as you keep tracking your portfolio stocks, and if something goes wrong, at that time you can take an exit. So in this index strategy, giving you an example, let's say you expect the index to fall from 17,500 by about 2,500 points, and you divide your investment into 5 parts, and every fall of 500 points you invest 20% of the money you want to invest in that particular stock. Let's say you want to invest 1 lakh, you invest 17,500, you invest 20,000, and you continue the same 20,000 installment in 5 parts at a difference of every 500 points. Now you'll get a doubt in the mind, if the market doesn't reach 15,000, it turns from 16,000 itself. So if it turns from 16,000 itself, and when you see a clear reversal, it's up to you whether, if you're particular and you're keen in allocating the complete amount to that stock, you can allocate that remaining 2 or 3 installments when you see a reversal on the screen in the markets. And you will also know that the reason for which the market was falling is clear now, and there is no uncertainty in the market. You can invest the remaining amount and allocate fully. So in this strategy, you are investing in installments based on the index levels. The next strategy would be for people who know at least basics of technical analysis. On the basis of technical analysis, by using any chart patterns or by using the moving averages or any kind of indicator, whatever you are comfortable with, you will decide the support levels of a particular stock. And whenever the stock is reaching a particular support level, you will keep investing more and more in that particular stock. For a simple example, let's say somebody knows moving averages. So let us decide that we are going to invest based on exponential moving averages as a simple indicator to follow in this strategy. You decide that I'm going to start investing in a particular stock, let's say at a 100 days exponential moving average. So you divide your investments into, let's say, 4 parts. So when the stock reaches the 100 days exponential moving average, the stock price reaches, you will invest your first installment. When it reaches a 200 days exponential moving average, you may invest your second installment. Now, when it even breaches the 200 days exponential moving average, you may switch to the weekly 200 weeks exponential moving averages also. So in that way, you can now switch to the moving averages, which is as per the week. The next approaching weekly exponential moving average, you can invest your third installment and the fourth installment after that. So this is only an example which I am giving you. In technical analysis based SIP, you can follow any strategy you want based on your knowledge and based on your comfort on the charts which you do the analysis. As you invest over a period of time, you will know which strategy is working best for you and you can decide one strategy on your own. In this also, if all the installments are not invested, when you see that the market is going up on the charts and it is clearly visible, you can choose to invest the pending installments. So this is the fourth strategy of systematically investing based on technical analysis. The next strategy would be, you can use a combination of any of these 2-3 strategies. How can you use a combination? So let's say we want to use a combination of strategy 2 and strategy 3, which is price wise SIP combined with index level SIP. So you decide that I will invest at every 5% difference in the price of a stock. So let's say you buy the stock at 100 rupees and you also decide that you will invest the second installment at a difference of every 500 points on Nifty. So whatever event occurs first, you can invest your next installment. So let's say you buy a stock at 100 rupees and it has reached 95. So you can invest the next installment as it has reached the benchmark of 5% difference at 95. Then next what happens is, the index falls another 500 points. That is from let's say 17,500, the index has reached 16,500. But the price of the stock has not gone down from 95 to 90, which was as per your pricing difference. Then also you can choose to invest as you are using a combination of strategies where you are satisfied that at least the index has fallen 1000 points and your stock is holding strong. That means that stock has strength. Even if the market is falling, that stock is holding strong. So you can choose to invest when the difference in Nifty is 1000 points. So like this, you can combine 2 strategies out of the 4 which we have discussed and make your own strategy to systematically invest in the falling markets. Just to clarify, these may not be official strategies which may be mentioned in any book. Just out of my way of investing, I am trying to give you 4 or 5 different ways where you can systematically invest based on your level of understanding of the markets and based on your comfort and style of investing. I hope you can easily understand these strategies, and if you are not able to understand, if you have any doubts, you can mention in the comments. I can give you some examples to further clarify in the comments. And I'm sure by using a combination of these strategies or by dedicatedly using any one of these strategies also, you will not get fearful about the falling markets and you can systematically allocate your capital. And when the market goes up, I am sure you will reap good benefits and make good profits from the rising markets. So before I end the video, I would like to give another quote which says, market is like a pendulum that forever swings between unsustainable optimism, which makes stocks too expensive, and unjustified pessimism, which makes stocks too cheap. The intelligent investor is a realist who sells to the optimist and buys from a pessimist. So don't fear the markets. Make a systematic strategy which suits your style of investing and your comfort and your size of capital. Follow that strategy dedicatedly and buy from the pessimist so that later, after a few months, you can sell to the optimist and make good profits. I hope you like this video. And I've tried to make it simple, and further if you have any doubts, please do mention in the comments. I'll clarify. So thank you for watching, and I hope this video helps you in this present market crash. If you like these strategies, do share them with your friends so that they can also be benefited with these and they are not at all scared in the pessimistic atmosphere around us. Thank you for watching and have a wonderful day.